Welcome, everyone. A little bigger here. Welcome to TAKESTOCK Live, our weekly investor webinar series, live every Wednesday, 15 minutes after market close, typically 3 companies for 40 minutes. This week, courtesy of Conduit Capital Advisors, we have a different format, including guest speakers. Next week, we return to our regular format of 3 companies. Next week's companies being cannabis-related companies, AYR, CIF, Cannibal. Mark's also back. Let me just advance the slides so you can see which they are, and I will toggle off. AYR Strategies, Can Income Fund, Cannibal Food Tech, coming up next week, bringing Mark Francis back, and a surprise moderator for you. We would like to thank the TMX Group and TSX Venture Exchange, our event partner, for helping keep the conversation between companies and investors going in these very unusual times. We also recognize the vital support provided by our core sponsors, Fasken, thanking our sponsors, Fasken, MNP, Lee Jones Gable, Olympia Trust, Dealmaker, and the CSE, who helped us launch the forum back in 2014. Thank you also to our extended network for their support in launching this new initiative. Calgary Meg, CIM, Sterling Merchant Capital, The Newswire, Investmentpitch Media, Kitco, and many others. Thank you. Thanks again goes out to Conduit Capital Advisors for this week's show. Conduit works diligently to link investors to opportunity for the creation of new wealth. They provide investor awareness to undervalued, underappreciated public venture companies or private companies with a goal of becoming public. At which point, I need to read you a note or disclaimer. This presentation is for information only and is not a solicitation to buy or sell stock. TAKESTOCK and its principals, Raj Joshi and Mark Francis, may have equity investments in companies invited to present. Make no representation or investment or other recommendation in regards to these presenting or any other companies. You should do your own due diligence and seek professional investment advice. Housekeeping matters. Chat board will not be utilized live in this session. You can still type and send messages, which will be followed up on by the respective companies post-session. So please be clear about to whom it's addressed. We will accept questions for consideration up to 2 days in advance of each session. This time around, each presenter will have up to a strict maximum of 8 minutes, with me appearing as a reminder 15 seconds before the time concludes. This will be followed by a panel discussion after all the speakers and guest speakers, and Q&A. We encourage you to connect with the companies directly in order to get more detailed information. Contact details will be posted to our website, takestocklive.com. I minimize, should be able to see the website there. Now I'd like to thank, now I'd like to hand over to Derek Wood, founder of Conduit Capital Advisors. Derek.
Thanks, Raj. Thank you, everybody, for attending. It is a little bit of a different format. Today, instead of 3 companies, we just wanted to showcase 2. And by no coincidence, these are both Conduit Capital clients. And then I wanted to introduce 2 great friends of mine, Chris Marcus and Andrew O'Donnell. You meet a lot of people traveling around at the various shows and whatnot, and some of them proved to be fairly like-minded, and as well as Raj and Mark, we thought we would join forces a little bit, and very impressive guys. So I think we're going to start with Andrew. Andrew O'Donnell's got a very career in financial services. He's worked in really all aspects of it. For the last few years, he's been a newsletter writer focused on early stage resource venture opportunities, or all opportunities really. And he is the managing director of a site, superchargedstocks.com. And he's a regular writer, both on micro and macro aspects of the markets, and really happy he could join us today. So that's the intro to Andrew O'Donnell, and I'll turn it over to you, Andrew, if you could turn on.
Wonderful. Thanks so much, Derek. It's a real pleasure to be here. Any chance I get to talk about what's happening in the markets is exciting for me. I come from a capital markets background, working at Merrill Lynch, RBC. I've done a lot of offshore type of structuring of products and some derivative work and whatnot. So I came to this by a commodity base. I had been writing for private clients and focused more on precious metal years back, and at the time was actually encouraging people to just simply their cash position, not even take an investment, just their cash, to consider gold rather than sit in a dollar, whether it's Canadian or US dollar, money market or whatever that they were getting 0.2% on. So that kind of broadened out to what now Supercharged Stocks was taking advantage of price irregularities, the fact that the junior market itself had been so overlooked and beaten down for so long. So this really is just a quick, real fast run through some of the changes that are coming to capital markets. And bear with me, this is a huge topic, and I'm not even going to do it justice, but we're just going to touch on a couple of the main themes that we're seeing right now. So I've put in the capital markets as being bonds, equities, and I put the junior market because, quite frankly, I don't talk about derivatives. It's too much of a high-risk speculative game or a hedge game that's for very sophisticated investors. My brother had a hedge fund at one point that focused on futures. I think that's a $600 trillion market, so it's a massive market. It's just not something I focus on and I don't promote. So I just decided to leave it out. But it certainly has an impact on what's happening moving forward, and more particularly what we're more familiar with is the bond and the equity markets, and then why I was kind of thrown into this junior market where the opportunity is. So we may have heard that there's roughly 18 trillion and rising of negative yield corporate sovereign debt. That's just the sovereign debt that's yielding negative rates of return. This is pretty much uncharted territory. Of course, Japan has done the same, yielding negative rates for a long period of time. So it can be done. It's just seeing the U.S. do it at such a monumental rate is a bit shocking. So that, on top of the massive level of corporate debt, would fundamentally show that there's deep issues that were happening far beyond and far before the pandemic or the COVID event arose, and is really kind of being the catalyst for the price change we're seeing. There is not a lot of good fundamental information out there that would be positive in respect to any kind of growth that people had expected. And really, you've probably heard it a million times. You've heard it from other people. Is that the analogy I like to use is in 10 years, if I have a son and he says to me, "Dad, what were you doing when they were giving away free money?" I didn't get any, but lots of companies got lots of free money, and they went and just bought their own company stock. They get paid for performance in their stock, pushed the stock up, got their bonuses, kept on pushing the prices up. That is a cycle that gets pushed further forward because these companies are all the same people. Whether it's BlackRock with $7 trillion, which I'll talk about in a moment, investment banks, Goldman, JP Morgan, Merrill Lynch, whoever else, they need to place massive amounts of money into big, highly leveraged and movable exponential growth products in order to keep forcing this economy forward. Eventually that can't continue. So I don't want to get too much into who owns all the debt here, but it is interesting because, and we'll talk a little bit more about it, is the Federal Reserve, which I always find humorous because it's neither federal nor a reserve, has 2.38 trillion of the U.S. debt. Now, as we know, they've handed over another 500 billion and more to BlackRock, which is their friends as well, to manage on behalf of the Fed. So the Fed isn't federal; it has nothing to do with the government. It is a private institution. I like to call it either the magic money tree or the printing press. The U.S. gets it because they created it. They were able to enforce it. They were able to first enforce it by coming off the gold standard and having taxes that would meet the demand and it would fit the model. I would look at it in the last 20 years, they were able to enforce it strictly by military means. If you decided you were talked about trying to come off their system, we saw what would happen, whether it was in the Middle East or elsewhere. But that has changed because there's active talk all the time between China and Russia of them coming off that reserve and that debt because they see the writing's on the wall. So unless something changes, there's some issues. Equity markets, we're going to see a lot of difference here as well because the MiFID II rules that came into effect in Europe haven't come across the water yet. But we're going to see a big push. And once again, you're talking about the same firms, whether it's BlackRock, McKinsey, Goldman Sachs. All these are, when you hear people talk about globalists, these are the globalist brands. Someone like BlackRock, last year alone, I believe they fired 98 presidents. So they have people on the boards of companies at an alarming number. And people say, how do you have a conspiracy? Or how do you have, well, if you put BlackRock on the board of my company and they give me $1 billion, well, I'm not going to do anything to piss them off because A, I'm not going to get access to those funds. I know what their statement of their goals are. They're very open about what they want to do and push. If they aren't aligned with mine, I don't have a say anymore. So it isn't hard to see how money flows and how once you take it once, you're in that net. So it isn't that there's some big major conspiracy. They're very open about exactly what they're doing and what they intend to do. But that has left a huge gap between you and I and 98% of the world that would like to take part in different ventures and to seed some to ventures compared to the placement of money that they will do. This is, even like a Warren Buffett will say, he misses the times when he could go into something kind of secretive and take advantage of it. He needs to move hundreds of millions of dollars at a time. You and I can move 10,000. And that's what kind of takes us into the junior market here. And that image in the back there is our S&P TSX mining index. Will that come up? Of course it will. It's cyclical. We know it's cyclical. It always is. And even if we're having strange kind of what I call clown world situations in the world of politics and economics, the need for mining is obvious. It may seem to us who have been beaten up that, it's over because it's just been beaten up for so long. And of course, the mainstream narrative, which also, once again, is just the PR agencies of BlackRock and Goldman and the rest of the ones that fund PR events on CNBC or even Fox or any number of them. They don't have a voice for a junior market right now. And it used to be a lot of junior equity firms, but they've had their hands tied as well. So there's this huge gap of where's the retail person supposed to go to have a shot at getting some exceptional gains. And they're starting to realize now that, especially in Canada, where we're a resource country, we should be taking more responsibility for our own financial well-being. And I think like 85% of our funds are in managed money. I think it's necessary for us to make sure that we look at some of the junior equity market moving forward. I won't touch on the tokens, coins, wallets, and fintech because that is a huge topic in and of itself, but that is how we're going to see things shift and change. But once again, where I kind of point out at some of this fintech, you can't have any kind of Bitcoin mining unless you literally have mining. So I want to just wrap it up. I've talked a bit about this, is how you're going to take advantage of this. There's a huge opportunity here in the junior sector. We see that now, even with the pandemic, that there's a lot of companies really shining. And I think people will look more towards stability, towards more of a defensive play that has aggressive growth. And that's really resources, commodities, and especially the junior mining market. So I appreciate you guys having the chance to have me on. Contact me anytime. I love talking about anything. And thanks so much. Have a good day, everyone.
Yeah, thank you, Andrew. Where'd you like to go next, Derek? Derek, I don't think your mic's on.
There we go. Sorry, everybody. Okay, that's great. Thanks a lot, Andrew. It's there's a lot to talk about what's going on in the world right now, and both Andrew and Chris, who will speak a little later, are bang on. You can check both of their sites out. They've got some great, insightful stuff going on. Andrew talked a lot about metals, and it's an important part of what's going on right now, I think, as people look for alternative stores of wealth. But, another thing that's really important, and it turns out that a lot of people that are precious metals bugs are sometimes agriculture bugs. And that was something I found when I was looking for things to do when the mining market was so dead, and I started selling some agriculture land products. And that led me into starting to look at some different agriculture companies that were actually listed publicly. And after I reviewed them all, I came across one and was fortunate enough to meet with Clean Seed Capital. Clean Seed Capital Group, Graham Lempriere will speak next, and it's a fascinating, game-changing technology. They've persevered over some very difficult and challenging times. They've had a string of very exciting news over the last couple of months, and it seems like they're getting back in the saddle. And with that, I will let Graham Lempriere just run through a presentation for you, and then we'll go on with one more presenter and finish off with Chris Marcus, the economic report at the end of the show here.
Thank you, Derek. I'll start my timer here because I only know we have 8 minutes. It's a rather long presentation, but I'll try and whip through it as quick as I can. Clean Seed Capital, we are in the agricultural space. We're in the agricultural technology side of the business. We have designed from the ground up the machine you see in front of you, which is a smart seeder. This smart seeder, we built 6 of these machines. We traveled all across Western Canada with our partners Rocky Mountain Equipment to verify and qualify that the technology executed and delivered what it was supposed to do, as these were the beta type machines. So the reason why we developed this machine, and we are the very first to pioneer variable rate digital metering control over every single row of the field. So a machine has 60 rows. Every foot of that field, we can put up to 6 products micromanaged in the ground from seed to nutrients, which makes it a highly sophisticated delivery mechanism for agricultural inputs. The reason why we move towards this area is agriculture is expanding as far as the agronomic benefits and the agronomic assessments. There are lots of companies out there that are soil sampling and coming up with these highly advanced input recommendations to maximize yield. But there wasn't really a technology to execute on those deliverables. The existing market had air seeders, especially in Canada, which you see there, like spaghetti junction really from pipelines, and it really was an inaccurate approach to delivering seeding into the ground. So we developed the new CX6 Smart Seeder, which you see again there. There's a map. That map shows you all the variances between green, red, orange of what the nutrient requirements in that soil are. So this drill actually acts like a giant printer, if you will, and delivers exactly that recommended recipe. We've been recognized during the development process by a lot of major news articles and news groups stating that we are a game changer in the ag space. We've proven the yield increases. Here's some imagery of root structure compared to the existing air seeder market. We've done an average of $100 an acre increase per acre for the farmer. That is a massive yield increase and a massive financial increase to the farm itself, and that is the real driver here for farmers. The government of Saskatchewan did an extensive analysis on our results. They gave us a 50% reduction in taxes to move some operations there. The government has been very supportive of our technology from day one. They've invested in the company, zero interest loans and grants. Not only is that a financial benefit, but also it's a big benefit to protect us in our patent protection as we evolve, which I'll get to as we go. The Canadian market is a $1.3 billion market for seeding equipment. We all need food. We all need advanced technology to maximize yield. This is the technology to do it. Canada represents $1.3 billion. One of the drivers for us is we needed we wanted our U.S. patent to be cleared so we could enter into the big boys arena south of the border into the United States. We secured that patent recently. And we've now moved to embark into expanding our reach into the United States because it's a $4 billion market. So you combine them two, it's a $5 billion market. To accomplish the manufacturing, we're not iron manufacturers. We are a technology company. Software, metering controls, data sensing technology, high resolution input technology. We designed the machine, but we needed a solid partner in the United States to build it. We recently announced a partnership with Norwood. Norwood has the facility to execute and build our machine. They're currently building our first one that comes out in the United States in the next 2-3 weeks. Superb partner to have. What makes this relationship extremely good as well is part of the relationship was not only a financial investment. I would say they're into this now for about $3 million, but also we have a tried, tested, and proven frame system that you see there in the image that all of our software hardware will be mounted on. That's currently in the final stages, and the market will see that in a few weeks. So we don't have to fork out the cash. We didn't have to invest in an acquisition. We did try one recently. It didn't go through as we hoped. This worked out better because we don't have the heavy financial outlay. Our partner here, Norwood, is doing the investment on the iron. Clean Seed has done all the investment on the technology side. We've also signed a worldwide agreement with a Brazilian company for the selenium meter. That selenium meter will be exclusively branded to Clean Seed. That is a direct competition to precision planting in the United States. This meter gives us the opportunity to go up against the Deeres, the Cases of the world, because combining this meter with our existing meters will be the only world's first full hybrid technology, which you will see soon. Recently, we announced a $5 million US transaction with AMVAC. $2.5 million US of that was an equity investment at twice the market price. And $2.5 million of that, on top of that, was for the licenses of access to our technology. Reason being is they are in the same philosophy as we are to maximize crop production in the world, and they developed their own technology that is very in keeping with what we're doing, so we decided to team up. It's a $400 million market cap company. It's listed on the NASDAQ exchange, on the New York Stock Exchange, and it has, so far, they've delivered on all of that they're doing. They are in production now. We have a royalty agreement that should generate about $20 million to Clean Seed over a period of time. We've also recently announced a deal with Exro. Exro is now a partner with us to electrify the ag industry. To simplify that, what that means is they're going to apply their technology to our drivetrain systems on our equipment, and that equipment will now be electronically assisted to reduce the fuel costs and the wear and tear on tractors, and also position us to offer aftermarket retrofit kits to the existing market to assist them in their own challenges with what they have. So we will be able to cash flow that sooner rather than later. The ultimate goal is we will have the world's first electric drill working with Exro that will accelerate that process. This is our new machine that will be out in the next few weeks. I won't go into details, but basically this drill has addressed any of the shortfall challenges that were with our larger drill. This now will fit in all of American markets and the Canadian markets and gives us a worldwide opportunity to distribute. We've been, all our software control systems are our own. They were all developed in-house. We do not subcontract anything to any third party. So all of this is our own IP and our own assets. I won't go into the details of this, but it's a game-changing software. We'll do more presentations on that later as we go. We also have data benchmarks that will be sending data to clouds. That's another subject we'll address another time. Just understand it's the most sophisticated equipment ag market has ever seen. So we'll be addressing a $5 billion market starting in a week or two. Our patents are worldwide issued across the globe in all key farming aspects. United States, Canada, Brazil, all the ones that matter are secured, and we've now got our first license agreement as mentioned. Strong management team, been there, done that in the ag space, owns 25% of the company. About 60% is owned by the farming community. I won't go through each details because I know I only have 8 minutes. So I'll wrap it up with a simple slide that we all have to eat. Crop production needs to go up, and we have the technology, equipment, and partnerships. We are capitalized now. We have manufacturing partners, and we will be starting the distribution process and demonstration process in the next 3 to 4 weeks max.
Thank you, Graham.
Thank you.
Okay, great. Thanks, Graham. Graham alluded to. It's hard to get into all these stories in great detail in this short period of time, but we certainly just want to give you a flavor of it. There's more info on the company's presenting websites. You can also go to Conduit Capital Advisors. We post information about all our clients on there as well. And both these companies, I think, tie into some of the more macro themes that are going on in the middle of this COVID crisis. I don't know, there's definitely been some food shortages around the world. There's going to be some inflation. I'm sure Chris will speak to that at the end of the broadcast here a bit. But, a big part of what Graham does is also he saves a lot of money on the input costs. And if we can feed the world cheaper, it's going to be a necessary thing. Next story is what I'm involved with. Brian Fowler is going to present Northstar Gold. I've been involved with Northstar for about a year and a half, and met Brian along the way. I'll let him get into it, but Brian's a 40-year geologist up in our region. He spent many years with Placer Dome Gold. He's worked on both the geology side of our business as well as the capital market side. He's built public companies, raised tens of millions of dollars, and we have an exciting management team all around. But it's really, really fun to work with Brian, and I think we have a great story here, and I'll let Brian tell it. Cheers.
Thanks, Derek. It's a pleasure to be here. I welcome the opportunity to present Northstar Gold Corp. Launching into, I've got the obligatory cautionary statement. I will be making some forward-looking statements. Prior to going public, January the 2nd of this year, Northstar operated as a private company in northeastern Ontario in the prolific Abitibi-Greenstone Belt and Kirkland Lake District. Our flagship property is the Miller Gold property. It's 100% owned. It's 18 kilometers southeast of Kirkland Lake. We also have a gold property 35 kilometers to the south called the Bryce Gold property. And our third 100% owned property is the Milestone Copper Nickel Cobalt property. Why Kirkland Lake? 24 million ounces from 7 mines. It's a great address. It's a great place to be. Prior to going public, the company augmented its board, special advisor, management group. You can see we've got a group of accomplished and highly skilled professionals, highly experienced in mining, exploration, development, capital markets, investment banking, and finance. Our share structure as it stands today is we've got 38.8 million shares outstanding, 47.3 million shares on a fully diluted basis. We've got $1.8 million in the bank, and we have no debt. We have a very nice, tight share structure. Just under half the shares are owned by management directors and insiders. And our last financing, we saw some institutional investment in the company as well. So since we went public, we've had a fairly steady news flow announcing the closing of the $3 million IPO and listing on the CSE. In late February, we announced the commencement of our 3,000-meter diamond drill program on the Miller Gold property. And in mid to late March, we announced and shortly thereafter announced the closure of a $1 million flow-through financing. And then in mid-April, fortunately, we had to announce a temporary suspension of drilling at the Miller Gold property due to COVID-19 issues and problems. So getting back to our flagship property, the Miller Gold property, it's 1,100 hectares. It's centered over the historic Boston Creek mining camp. It shares a number of very important geological similarities with the Kirkland Lake deposits, that being the style of mineralization being gold and with tellurides, fairly high grade. The deposits on the Kirkland camp are situated along the Cadillac Larder Break and first order structures off of that. And the same kind of goes with the Miller Gold property. We have a Catherine Fault, which joins up those structures to the west. We also have similar age rocks. The age of mineralization is the same as the Kirkland camp. So the inference is that the Miller property is tapping the same gold source as the Kirkland camp. Major important difference being that exploration in Miller has been pretty shallow to date, and we've got a lot of upside. So zooming into the property, it's centered over a 3 kilometer by 2 kilometer zone of intense alteration and mineralization associated with these alkalic, what are called alkalic cyanide intrusive stocks, and a broad mineralized zone and envelope associated with them. These stocks intrude mafic volcanics. There's historic work on the property, and in the early 1900s with Miller Independence Mine, which saw in late 1987, a group came in and drilled 27 shallow holes and defined a historic estimate of 270,000 ounces of gold at 11.5 grams per ton. This occurs in a kind of east-northeast or east-northeast trending and shallow north dipping vein structure. Northstar owns the entire the west half of it, plus all the down dip extent of it. In addition to this estimate, we also have what's called a exploration target on the planet cyanide, where we've got indications of up to between 3 to 5 million tons, averaging between 1 and 3 grams per ton, which could translate into a significant amount of gold associated with these cyanides. Two styles of mineralization here: high-grade gold in veins with tellurides in all rock types, pretty much, and broad low-grade zones associated with the margins and peripheries of these cyanide intrusions. Northstar acquired the property in 2012, put $2 million into it prior to this year, and that work consisted primarily of drilling 27 holes, just under 6,000 meters, testing a number of these targets. So some of the results from that drilling, you can see broad low-grade intercepts, gram-type intercepts over 97.5 meters, gram over 104 meters in the allied cyanide. Plus, there's narrow, higher-grade intercepts, 40 grams over a meter in the allied planet cyanide, similar, 0.6 grams over 148 meters. The number one vein where we've hit it you get some very compelling grades as well. So the property's got two very significant styles of mineralization, and the cyanide seems to be the core of the whole mineralizing system. Between February 22nd and April 4th, the company drilled 2,211 meters and 13 holes prior to having to suspend drilling due to COVID situation. This map just illustrates the location of the main historic estimate. About half the holes that we drilled were within the estimate domain, twinning previous holes and then stepping out a bit. And then the other half of holes were directed towards vein-style mineralization in the D vein to the west of the property, as well as and then to the north on the allied cyanide for intrusive posted-style mineralization. When we hope to we intend to report all our drill results by the end of the month, the end of May, and hopefully resume drilling thereabouts. We'd like to continue with our program and drill up to another 14 holes in 1,200 meters. This all depends on the COVID situation in Ontario. So, in summary, I'd like to hope that I convince you that the Miller Gold property is a property of merit. Northstar represents a very solid entry-level gold exploration bet. We've got a very tight share structure, proven board of directors and management. The stock has performed very well through a very aggressive marketing campaign. The share price is up 70% since the IPO. We're fully funded. Our news flow will continue. Like I said, we're going to be coming out with drill results here fairly soon, and hopefully a resumption of drilling. We have a very substantial geophysics program that's going to kick off in June and over the entire property. And this will provide the premise and basis for a phase 2 4,000 meter drill program, which is fully funded. We expect that to kick off in August, mid-August. And all of this is leading up to a 43-101 resource, a maiden resource that we hope to be able to put out by Q1 2021. Thank you for listening.
Okay, great.
Thank you, Brian.
Thanks, Brian. Thanks, Brian. So that's just we're just having two companies present today. If you want some more information, you reach out to myself, or we'll be sending a follow-up email, with links to the speakers today, as well as the two companies that we're presenting. Conduit Capital Advisors, we don't take on very many clients. We turn away a lot of business. We take a client on, we there's a lot of due diligence done, and very proud to represent both these companies. And if you want to hear the good and the bad and the ugly about any of them, give me a call anytime. Chris Marcus now. I've met Chris now for probably only about 6 months at some of the various mining shows and whatnot, and I've signed up for his regular podcasts, and recently I had the opportunity to read his new book or listen to his new book. It's an audio book. Chris has a career that has been a Wall Street trader and Wharton School of Business. He's well connected. He's got some real issues that I kind of share about where we are with the US dollar and stuff, and he's really happy that he's joining us here, and hopefully you'll subscribe to his page and maybe read his book. Chris, there you go. Thank you so much for coming out.
Thanks, Derek. It's a pleasure to be here. Nice to see everybody else again, and I think you're in good hands. I think Andrew, some of those slides he laid out, really the key highlights, because what stood out to me as a guy who had worked at Moody's and got an MBA, was working on a trading floor, and then sitting there completely sidewinded by the collapse of the subprime bubble and thinking, A, wasn't I the guy who was trained to see this? And B, I guess there's a place for hedge funds that are duking it out over 2 or 3 basis points, but it seems like when you have these big shifts that happen, you saw how the whole thing got repriced. And what I found was interesting is that as I sat there and watched, Ben Bernanke and the Fed talk about how it was the perfect storm that no one could have seen, I found there were a bunch of people who saw it, wrote books about it in advance, saw it quite clearly. Oh, thank you. There, we got some slides now. So that really led me on this quest because, again, my background was as an option trader. And by 2011, when silver hit $49, gold hit $2,000, had a bunch of options on GLD and SLV, which worked out better on the way up than the way down. Yet what stood out to me, it just always seemed bizarre that here we were in 2011. Keep in mind, this was following QE2 from Ben Bernanke and the Fed. Also in 2011, the US got downgraded because they just kept blowing through the debt ceiling. And the Tea Party put up a fight for a while. It was quite a spectacle. Now they just kind of ignore it. And again, like Andrew pointed out, and similarly why Derek has agriculture and gold companies, I think we're in for the rally of a lifetime in some of these commodities, and especially silver, because it comes down to, well, we've printed a lot more money. We're tacking on debt faster than ever. Why did those prices fall in 2011, which has been my area of focus? So why would anybody really care about silver as it meanders around $15, has been sitting somewhat in that range for a while? Although, again, what I like to do is put this stuff in simple context. Doesn't have to be complex. Here you see the debt clock now over 25 trillion. It's funny, I checked last week, it was under 25 trillion. So that's getting piled on fast. There's no talks about cuts, just how quickly will we hit 30. And you have a blank check concept in both the government and the Fed, which is alarming. Here's a quick chart. You see how this has been going exponential. If anybody could explain to me, again, I host a show where I talk to fund managers and analysts around the world. I have yet to hear anyone even present an argument that's going to turn around. And of course, with what's happening with Corona right now, we see that it hasn't. This one here is kind of special, and I think puts in perspective what even 99% of Wall Street would not be aware of. This is the monetary base. So as far back as I could get was 1960, but we always talked about the US printing a lot of money. And then here's where you get to 2008. So you had just under $1 trillion back before the last crisis. That's spanning almost 100 years of the Fed. Then they double that in an afternoon, basically. Somewhere around here is 2011, where both gold and silver hit their peaks. And, you know, we had this narrative over the past decade that the Fed was tightening and they were going to one day, you know, raise rates, which of course never happened. They tried back in 2018, and I'm sure many of you remember how quickly the stock market melted down. And it's just gone exponential since then. Here's a little bit of tightening, which you can see has been blown out of the water. Interestingly, as we're doing this, I just see some email that Jerome Powell is concerned and more stimulus might be necessary. Little disconcerting when you're already printing unlimited. Here's another chart, I don't think we got all the way up to that $7 trillion mark, which it sounds like Jay and the boys are going to do soon enough. Back to silver, you know, again, as Derek mentioned, I wrote a book laying all this out. So if someone is hearing all this for the first time, as simply as I could put it, written so that my mom could, actually written so that even a congressman could understand it. So it's that simply worded, and, you know, lays out a lot of the background. Here you see a current event in response to Corona. It's an article by my good friend and great analyst, Jeff Clark of goldsilver.com, where he's reported was able to catch 32% of silver has gone offline. The production, if you factor in China, which is not always forthcoming with their numbers, that's 50%. Again, you can see, according to this chart from SRS RICO, silver has been hit the hardest. Again, interesting, we saw a surge in demand to the point where bullion dealers have no product to sell. Now that's come back online a little bit, but you have demand rising, supply falling, and somehow the price went down below the cost of production, which we will cover before we wrap up here. But one of the things that's interesting, a lot of attention being focused on gold, and rightly so, when the Federal Reserve is basically, I mean, geez, if that's not hyperinflation territory, when you're printing so much, you can't even put a number on it. You know, now gold around 1,700, not far off from its highs yet. Silver, nowhere near it at 15 bucks, because April 2011 got up to 49. Of course, as many of you remember, I mean, not only is silver a third of its 2011 high when we have unlimited printing since then, but it's a third of its 1980 high. And I don't think there's anyone going to raise interest rates like Paul Volcker, because here, now this was back from March, Fed saying aggressive action is needed, starts unlimited quantitative easing, and apparently unlimited is not enough. So you saw the debt chart, you saw the money printing chart, and I think a lot of people are wondering, geez, well, why is silver still at 15 bucks when you also have a big industrial component? And the simplest way I could put it is showing you this chart back in April of 2011. This was shortly before the US was downgraded, but you see on a random Sunday night, opens in the Far East, and silver in the midst of quantitative easing round 2, which I might add, the Fed now prints more in a week than QE2, which lasted 7 months. So, I mean, we're not just a little bit. Yet you saw the price of silver get hammered. It's never quite gotten back up to those levels, primarily because it's traded in paper. So you can go in and say, I want to buy 1,000 contracts. A bank can say sold, 1,000,000 contracts sold. There's a lot of paper, gold and silver that doesn't exist. Again, why you may want to check in with Brian Fowler, who just spoke, because he's out there digging for gold. I am a big fan of the miners as well, because basically you have a market that's suppressed. Here is one headline, just billion dumped in paper gold, $2 billion dumped in gold contracts, $2 billion of future selling. And again, my background is options trader. We're specifically trained. You would never execute an order like that for obvious reasons. Here's an excerpt from the book where David Morgan, the silver guru, mentions how for each physical ounce of silver, with all of the leverage that's out there now, there are 500 people who think they own it. and I might add that was before he said that. That's before you factor in derivatives. Here is former commissioner of the CFTC, Bart Chilton, who I was fortunate to interview before he was passing, was present for their investigation into the silver manipulation, and he confirmed everything that I'm saying here. So I know this is, and by all means, if this seems any of this too fantastic to believe, I completely understand. I actually wrote a book. I mean, I set out to disprove this. I figured I must be missing something, but again, this video is on my YouTube channel. Any of these links I'll be happy to provide to anyone. Here's Andy Scheckman of Miles Franklin, who talks about how in 2008, when Bart Chilton confirmed JP Morgan was making their position bigger. So you have a big short position. The price went from 21 to 9, and you had a shortage. Same thing that's happening now, although now here's JP Morgan charged with the RICO Act. Deutsche Bank caught rigging silver, Bank of Nova Scotia. And in the end, you have good times coming for the metals. I think my time is about up here, but any questions, gold and silver, welcome to reach me at chris@arcadiaeconomics.com.
Thank you very much, Chris.
Okay, thanks, Chris.
Derek, I think we've got about 15 minutes left. We still got our audience here. We're going a little bit further than our traditional show, which would have concluded now. So if everybody's happy to stick around for some discussion.
Yeah, most people are still in the room, and I just want to thank everybody for speaking, and I really look forward to working with all of you going forward. I think we're at the very early stages of a good run for some companies here, particularly like in the ag tech space is a very interesting space, but the mining space is sort of part and parcel. The same devaluation of the currency, I think, is going to require some increased efficiencies in everything. And agriculture is what feeds us, and of course, gold is what stores its value. So, two great shows, two great speakers. I hope you continue to follow us. We'll do a follow-up email. I just have a few questions.
I've just decided, in case people taper off, let's pop up their contact details first, right now. If anybody wants to take a look at that.
Okay, we're going to do a follow-up email.
We're going to do that. I'm just going to flash them up there on the screen. Give people a minute.
Thanks.
This will also be available on our website, TakeStockLive.com. And actually, I'm going to do the thank you, everybody. As speakers, we're not concluding. We're going to have the Q&A continuing, but thank you to the attendees that have attended. Stick around. The panel is about to start, and come back next week, 15 minutes after market close, for a lineup of cannabis-related companies and a surprise guest moderator. Over to you, Derek.
Sure. So we took a few questions beforehand, and there was some more that came in. And we'll have the companies respond to them. But for Brian Fowler, I'll just, Andrew Kennedy had posted a question, and he was asking about the depth of drilling on the Miller property. He says that he followed the Kirkland Lake story for a long time, and it seemed that the higher grade mineralization was at a depth lower than your drilling. Why are you not drilling lower, and can you comment on that?
Good question. These systems have incredible continuity depth-wise as well as along strike. We've got the Miller is not a one-trick pony, which is great. We've got great broad zones mineralization within two of the intrusives. We also have the number one vein, which is a flat line and dips towards the cyanide. It's always best to try to limit your initial drilling shallow and try to find your resource that's much more economic the closer to surface. And the number one vein zone is certainly near surface and has a shallow dip, dipping towards the cyanide, towards the heart of our property. Our deepest holes are probably in the 300-meter range, and they would be within the allied cyanide area to the north, chasing the number one vein north, as well as chasing bulk tonnage style mineralization and high grade within the allied cyanide. Hope I answered that.
Well, that's great, and of course, again, just feel free to follow up with more questions anytime. And anyway, there was a question pre-populated for Graham. as well with Clean Tea Capital came from Ian Fleming. And he was asking, he says he's been a shareholder a long time, and he notices that you recently got financed at 40 cents US a share. And he's asking, when most financings are done at a discount, how did you get such a premium, and why is the market not trading anywhere near there yet?
The premium is related to the relationship between the parties and understanding of the value of the agricultural technology that we have. They didn't view the valuation from a stock price perspective. They looked at the value of the technology as it sits and how it can play a role in securing and expanding their own IP portfolio. So through several discussions, we came to an agreement at 40 cents US price point. As far as the market is concerned, why isn't it trading up there? Last year, I was at the TAKESTOCK conference, and we were in the final stages of looking at acquiring Harvest International. We raised $20 million, and we were moving to close that transaction, and there was a material change on the Harvest side, and we had to pull out of that. And that took a pretty big toll on our market, and people were concerned whether we were going to recover. And we have done that, and we've struck several deals in the meantime. And we decided not to over market at the moment, whether that's right or wrong because of the COVID situation, but we're about to bring the new machine out to market in the next 3 or 4 weeks. And when we do, we'll start re-engaging the market and exposing and what we have and where we're going, and try and generate more momentum. It's a very thinly traded stock. It's tightly held. Most of it's held by farmers and management. We do have 50-cent warrants out there that will start to come out once the market starts to move, that maybe will bring some more liquidity to market, but there's just no shares to buy. So we're trying to address that right now, and in the next 3-4 weeks we'll start to push the new technology and the new partnerships with some programs that we have lined up.
Okay, great, thanks. I guess this would be one of your first presentations since the announcement, so we're lucky.
This is the first.
It is the first. Okay, wonderful. There's a question for Mark. Chris Marcus here, and the question is: it says your site says that helping you thrive while we watch the world die, and the question is, when will the dollar die?
Well, I think you said the world die the first time, and I hope that's not going to happen.
Yeah, I sort of watch the dollar die. Yeah.
Yeah, and I mean, I think it's happening now, to be completely honest. I mean, we're not talking about one day gold's going to rise or one day the Fed's going to do this and that. I mean, they're already printing unlimited. Now they're concerned about more. You see foreign counterparties walking away. You see a lot of money flying out the door in response to Corona. So I think the question is perhaps, when do we see that spike in gold and silver? There's a lot of evidence between the liquidity warnings and the game of musical chairs between the COMEX and LBMA. The fact that you have bullion dealers paying over spot for physical metal. I mean, at some point, you can have whatever price you want on the COMEX, but people are paying above that because it's becoming irrelevant. To me, we're headed towards something very similar to the end of the London gold pool, which resulted in Nixon removing us from the dollar standard. And selling metal that doesn't exist, it can go on until people come in and say, I want physical delivery, and there's been a lot of concern over that. So when does the dollar finally die? Hopefully it'll be a smooth transition. I don't think it has to be negative at all, and that's why I'm grateful to be part of the calls like this, where once you know what's coming. I think it's unfortunate Wall Street doesn't share that, but people can be prepared. You can also hedge out the timing. You buy stocks that have a good balance sheet. Really, almost in any of these commodities, but certainly gold and silver. And then you don't have to worry about whether it's today or tomorrow. And if you're earning income, you can continue buying at good prices, which is what works in the long term.
Yeah. Chris, what do you think? Exchange traded funds. Some people think they're buying gold. They buy the GLD or the SLV for silver, or I guess they're the exchange traded funds that perform right along with gold and silver. What do you think of those investments?
I'd be pretty darn selective with the ones I choose. Right now, you have a big premium between physical metal and GLD and SLV. You can't just call the custodian and say, I want my metal. It's like in 50,000 share lots, and there are a lot of pretty well-informed folks who doubt whether the metal is added. I've called them. They say that it is, but I would say if you have a bet or an opinion on gold or silver over the next week or two, then yeah, it can be useful for that because the premiums on physical bullion are going to be higher than GLD or SLV spreads. But if you're really saving as protection against this dollar racket and what the Fed is doing, then I would be very careful about those. And if you have individual questions, you can reach me at chris@arcadiaeconomics.com.
Okay. So, Andrew, just a question for you quick, and then we can follow up. Please do send any follow-up questions or anything. But the question is, Andrew, are people better off to buy just gold and silver if they like gold and silver, or should they buy gold and silver shares?
Great question, because it ties in with the ETF one. Listen, I think people, and I've been telling them for years, to buy physical. Yeah, you're going to pay a premium for it, and there's a storage cost, and there's everything else. But I think, if you've done it, certainly gold. Whenever I first started talking about it, it was 1,100. It's 1,700 now. As a cash position, when I first started mentioning to people simply on their cash position, that's a hell of a gain. And we're talking about ETFs too. Why are you buying them? Like, it's basically a derivative product for all intents and purposes. So if you're a hedge fund manager, you're a portfolio manager, you're going to use a derivative to solve a derivative problem, and that's great. You need the liquidity. It's a great tool. But for people, when they're looking at it as a risk of the dollar devaluing and whatnot, if it's a piece of paper, which a lot of these, and like Chris said, you have to be very careful. You think you might be getting something, but you may not be getting something. How much gold or silver is really behind that ETF? And if at the end of the day you're just getting a piece of paper, you just have a piece of paper, a derivative product that is meaningless and you can't ever quantify. So if it's that you're scared of the economy and you think it's volatile, and you think there's lots to be worried about, I like physical. It's mine. I can go pet it. I can go look at it. It sits in a vault or whatever. And that's what family offices, funds, that's what central banks have been doing. They've been buying this stock, like stockpiling it. They're doing that with all sorts of commodities. So for me, is if you have the money, if you have the opportunity, you take the physical, especially during times of this great uncertainty. Just to make a quick note too, I'm so thrilled to hear the update about Northstar. I've written Northstar up well over a year ago, and I have I didn't know the seed capital story, but that one I'm tied to and do as well, which I'm glad to say, because I work with XRO, and XRO is a fantastic company. And it's great to see them working with seed capital, providing energy conversion and solving some of these problems that are facing the world moving forward. That's what I love to see, is these stories that are commodity based, they're fundamentals, and they're not reshaping the wheel. Like, they're taking something and they're making it more efficient, they're making it more effective, and they're harnessing the capabilities of our technology today. So I'm thrilled to be on this. And of course, always listening to Chris is awesome. I love that he put a lot of meat to some of the general themes I had. It was great to see the charts. I mean, it's shocking to see some of those charts. You just think, how do we live in this? How is this happening? So it's just, I mean, it's amazing. So right now, it's it's always cautious to talk about how terrible things are, because no one wants to hear the doom and gloom all the time. But at the same time, it's kind of like what I mentioned in PDAC at VRIC was, this is going to be one of those weird situations in time, whenever it's the Great Depression and the Roaring '20s smushed together, and depending on where you are and what you make of it is how you're going to end up. So it's definitely interesting times.
Yeah, awesome. I thank everybody for coming on the call. There's a lot more questions we could ask, but please feel free to reach out to myself directly. Conduit Capital Advisors, by the way, we renamed Conduit Investor Relations Conduit Capital, just to reflect some of what we're trying to do, which is help companies in a variety of ways, not just investor awareness, but we help with capital raises and all kinds of stuff. And we just see nothing but opportunity ahead of us in the resource market, the overall market, when this thing settles out here. So, you know, it's important to look at the economics behind it. I think the overall market conditions, and then you got to do a whole lot of research before you look at individual stocks. And we focus on that small cap part of the market where we think the opportunity exists to create substantial new life-changing wealth for stakeholders. And that's one of their criteria for what we take on. So if you don't follow me, please do. We'll send a follow-up email. There's Raj, and we'll have all the companies answer all the other questions in due course. So thank you very much, Raj, and Mark, if you're listening in anywhere. Cheers.
Thank you, Derek. Thank you to all our presenters, our audience. Please do send in your questions. We can continue to pass them on to the presenters, and we will be expecting a follow-up email to go out to all of you on Monday. Is that right, Derek?
Yeah. Hopefully we get it done on the weekend. We get it out on Monday. That's the plan, and we'll provide links to all the presenters and company websites as well. So hopefully you sign up.
Good.
Keep up to speed on what's going on everywhere. So
perfect. Well, everyone, be determined in your due diligence and ask tough questions. Thank you very much.
Thank you. Cheers.
We'll wrap it up. Cheers. Thanks, Derek.
Bye now.